Welcome to Theo Trade. This is Don Kaufman. You are watching the weekend update. It's May 14th, 2016. Let's start with a quick week in review and then forge forward to some areas in the market that I'm finding not only interesting right now, but some trade setups in. So I'll start with the SPX, which I believe is probably the best, again, kind of litmus test for the entire marketplace. And what I've set up to begin with here happens to be a year-to-date chart. So we're year-to-date in the SPX. Right over here, it's a IV percentile, which is actually an IV ranking. So you can see implied volatility, kind of where it's ranking right now versus where it's been over the last 52 weeks. For those of you that are familiar with the IV ranking, this is the same IV rank that happens to be found under option statistics on thinkorswim in the trade tab. So just a label that I happen to put on the chart. It's a script. That script is found, okay, in the members area, of course, of Theo Trade. We share any and all scripts that we have. There's a reason I'm looking at this right now is, you know, in the last few days we're seeing some sell side activity, but what do we see in volatility? Nothing. And down below, additionally, I placed, well, implied volatility. So you can actually see the implied volatility, which is, that's the way the options are kind of pricing risk in the marketplace. So the week in review here, what are we actually looking at? There's been a little bit of sell side activity in the marketplace. Now, I'll tell you, Friday towards the middle of the day kind of caught me by surprise. Looked like it was going to be a rather docile day. Markets sell off a little bit into the close. But again, kind of zooming out over here, where have we really been this year? All right, and again, notice I'm using a percentage chart just to really kind of enunciate, well, so the S&P's right now year to date about 1.69% return. Again, and that's specific to the SPX. Now, this past week doesn't necessarily concern me all that much. However, what does concern me a little bit more, and we're going to take a look at here, is a few of the sectors. Okay, prior to going into some of those sectors, though, just to point out how incredibly tight the range has been inside of the S&Ps as of late. And again, we're going all the way back here into you know, the early March kind of time frame. And again, I'm looking down below here, and it's kind of the early March time frame here that we have been and not just in a relatively tight range, but for the most part, what I've kind of boxed in over here is we're trading, you know, 2040 in the S&Ps and peaked out. You can see it right there, you know, peaked out at 2111. But the vast amount of the trade that we've seen, and again, if you're not familiar with this, we're now in mid-May. I mean, we've had, you know, 8-9 weeks of, again, an incredibly tight range. One of the things we need to be thinking about this coming week is we're right at the lower cusp of that range. Do we break it? If we do break it, do we see some of this complacency kind of end? Do we head into a little bit of a free fall? One thing that I've been watching really carefully this week, and I have taken, okay, a position within, is the bond market. The bonds, okay, the only way to really describe them is they've never traded at this level, but maybe once or twice before. Okay, and when I say, you know, the bonds have never traded at this level, I mean, we're looking here at almost 167, which is taking yield, and yield is ultimately what you get for having bought that bond over there. You know, some type of yield, taking yield to unprecedented lows. You know, if the Fed is going to raise interest rates, tell you what, the bonds are saying the exact opposite. The bonds are saying the world believes interest rates not only stay low, but they could even go negative. That's why we're looking at the bond. This is a 30-year bond. But moreover, the reason I bring this up, the bonds are kind of what I call trading in the Armageddon land. And that basically means, all right, one of two things, okay, is going on, or possibly both things are going on in the bonds. Number one, the world is buying bonds because there's no other place to get yield. So there's trillions and trillions of dollars of sovereignty out there, from China to Japan, okay, to different places in Europe that are all negative interest rate. So they might be coming over here and buying our bonds, which are clearly rallying them up, taking our interest rates, our yields even lower. That's reason number one. Reason number two, the entire professional trading world sees risk coming, and they're buying bonds to mitigate their risk. Now, there's no definitive, in between over there. It's going to be, again, one, the other, or a little bit of both. Either way you look at this, people look at the VIX. The VIX is as dead can be. The VIX isn't going to tell you anything, all right, until the market risk is on top of you. Bonds, look at this as a warning sign, all right? So those two scenarios, negative interest rates or the world sees risk coming and that's why they're buying bonds, both of them, are really, I think, kind of dark omens for the broader markets, and that specifically is to the S&P 500. So what I started doing when I was looking at some of this data, and I'm a big quant geek and a little bit of a data miner, so I started going through quite a bit of data, a lot of different symbols, and I don't spend a lot of time on charts, but it's a great way to display this to you. So on a year to date, take a look at the S&P. Now we're going to go over to some different sectors, and again, this is where I think you guys will feel what kind of risk we're getting involved in. One thing that kind of caught me off guard is, I worked around the industry for a long time, got a couple of buddies have been in the industry since the early 70s. I kind of call them the old-time traders. All of my old-time traders have been pointing out, look at the transports. So great. Let's start with the transports over here. And forget so much about a year to date. Yeah, they're up about 2%. So the transports have actually performed. By the way, there is no implied volatility. There's no IV percentile. But the transports have actually outperformed a lot of the markets, including the Nasdaq and so forth. But what was pointed out to me is, don't look year to date. They go, hey, look how much the transports have already declined. So from some of the recent highs, right over here at 81.49, they were up about 11%. Now they're only up about what? About 2%. It's a fairly substantial decline. And again, from the most recent highs over here, it's about an 8% decline that we've seen inside of the transports. Again, this is just coming back, 2 weeks in time. All right, that's April 28th. So great. I looked at that. Next, I cruised over to another sector. And it's a sector that's, it's been in the news constantly. It's been driving a lot of the order flow out there, driving a lot of the markets, and that happens to be none other than the XLE. So I cruise over to the XLE, and I take a look. First of all, the IV, it's not that high. It's 32%. All right, it's in the lower 1/3 of where implied volatility has been, and you can kind of see that mapped out over here. But again, right over here, that 428, 429, it's right there with the transports, which technically should be the XLE. Transports kind of trading neck and neck. This, in just the last few weeks, has had about a 7% decline in it. All right, so not faring all that well. So then I kind of cruised on over here, and again, I'm going to go into some of the uglier sectors. Then I take a look at emerging markets. And again, I know which sectors, are kind of in play and which sectors drive a huge amount of the order flow out there. So in that very same time frame, here you see, 11%. Now they're only up about, 3%. You're looking again, 7-8% decline. For some of the most recent highs, if you want to go back a little bit further, you're actually looking, again, at a 10% decline in emerging markets. Now, that one I actually found very unusual. Why are the emerging markets declining when interest rates are actually going down? That opposes a lot of the logic over there. Lower interest rates typically help emerging markets. So emerging markets over here not faring very well right now. And again, you could look at Chinese markets, look at Japanese markets. Not necessary. It's just not necessary. All we're trying to do is get a better feel for what some of these individual markets are doing. Then, of course, I had to go over and take a quick glance at retail. And again, right in that exact same time window in the last 2 weeks, retail was 6%, almost 7%. Now is actually down about 4.5%. So retail, you're looking at about an 11% decline. Once again, need I point out, implied volatility is incredibly low percentile. That scares the heck out of me. Okay, a 10 or 11% is considered correction territory. Implied volatility isn't even participating. The market's completely and totally complacent on this. Okay, so then I took a glance back, and you can look at the SPX or you look at the spiders. Listen, whatever does it for you. I'll go over to the spiders because I've been using a lot of ETFs. And you look in the exact same time window, and I'll even zoom in over here in that time window, right about 2 weeks ago, and you'll see here's the spiders, 4%. Okay, now up about 2%. The S&Ps have only had about about 2% decline. It's been absolutely negligible in that time frame. What's even holding the S&Ps together at this point? Transports, 8% decline. XLE right with it, 7-8% decline. Emerging markets over there, almost a 10% decline. Retail, 11% decline. Now, I'd be remiss not to point out, okay, the Nasdaq. So we'll actually take a quick glance over at the Qs over here and see where they stand. Again, we have individual sectors that are in full-blown correction territory. In a very similar time frame, the Nasdaq, okay, is also not faring half bad over here. So look towards technology, which again a few weeks ago was kind of getting hit hard. Technology right now is faring not so bad. Again, if you look back since the April 28th time frame, technology slipped another 2%. It saw some sell-side activity even earlier than the rest of the market. So again, technology not faring too bad inside of the last 2 weeks. This could be an area of coming weakness. What I'm trying to get to by going sector by sector over here, you already know that transports and energy have been hit. Okay, we know that emerging markets have actually taken a little bit of a dip. All right, we are looking right now, obviously, at retail, which is getting just decimated day in and day out over there. Where do we look, though, if we want to take kind of a bearish position? All right, do you look towards Nasdaq, which is of course going to be technology? The one thing that again shocks me most inside of the Nasdaq is how low the implied volatility is. Seeing that if you do want to look back a couple of weeks, this is still a 4 to 5% decline in markets. Implied volatility is not participating. But I have to bring up the XLF. Why? Because the XLF, okay, ultimately the financials, they could be assuming tremendous risk in a lot of these other sectors, and yet they have remained completely, for the most part, unscathed in recent weeks here, where you actually take a look at the financials. It's like, what, are they participating? Sure, they've sold off just a little bit. Less than a 3% decline inside of financials. Implied volatility is a little bit higher than the rest of the market, but this is an area I believe, okay, could be where we want to take those positions. Now, you don't necessarily have to go in here and trade the XLF directly if you're looking for a bit of a short bias. Again, the Nasdaq's been hit a little bit harder. Okay, the retailers, the transports, energy stocks, emerging markets over there, all of them have been a little bit beaten and bloodied over here. The S&P itself, negligible decline. The XLF, negligible decline. And the XLF, again, surprises me possibly the most on this front, simply because bonds rallying typically hurt financials. It's my belief financials right now, that's the sector that stands the most to lose in coming trading days. So now, and what we're going to be doing throughout the course of Monday at TheoTrade in the chat room, catch us on the archive, we're going to look specifically into some of the financial stocks. Okay, many of you have seen me take a bearish position in Bank of America. We already exited that. We're going to look through a number of different financial stocks, and we're going to build, a fairly considerable bearish position in these financials, seeing that, again, the financials unscathed, volatility still inherently low in this particular product. Okay, a lot of opportunity still exists, of course, in the financials over here. It's just going to be a matter of finding which financial product, all right, is really suitable and which one we're going to get the most bang for the buck at. So that's what we're actually going to be doing on Monday in chat room here at Theo Trade. Again, many of your retailers absolutely hammered. Okay, in fact, as the week progresses, if some of the sell side activity persists in the retailers there may actually be some long opportunities, that is some buy opportunities inside of retail, as a few of the stocks hit fairly tremendous oversold kind of territory. Again, many of you probably saw, from Kohl's to Nordstrom's to Fossil. Okay, the only problem in there, liquidity. Stay tuned to Theo Trade all this week. Thanks a lot, everybody, for joining me here on the Weekend Update. Have a good weekend. Bye-bye.